And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Tuesday, Two Dads on Money. That means John Penn's joining me this morning. We're going to talk a little bit about life insurance products, and particularly cash value life insurance. I've had a lot of questions about that just lately, and again, there's been a lot of videos going around the internet, social media, etc., talking about how to be your own bank. You know, buy this whole life insurance policy, overfund it, be your own bank. It sounds great on the surface. There's some pitfalls for that, and so we're going to kind of go through how that works today, kind of how to help you try to avoid some of those pitfalls. It's a good idea, right? I mean, the idea is correct. It's just not as easy as they make it sound on the internet, as is most things that are on the internet. But, you know, outside of that, again, we're lacking economic data, so not a lot to talk about on that front. But this week we will get CPI. Today is Netflix, so we're going to have some big earnings reports coming out today and tomorrow. And then, of course, next week is the real crux of the S&P, which will be Apple, Microsoft, Meta. They're all next week. So we're going to have quite a few between today and next Friday is going to be like just a rush of earnings reports from big companies. So those are all coming to bear. And then, of course, that's going to wrap up by next Friday, about 80% of the S&P be done. That's going to reopen the buyback window. So as we reopen that buyback window going into year end, we should get an additional kind of lift to the markets. But having said all that, you could have a bit of bumpy road between now and the end of the month. October is the largest calendar year-end close for mutual funds of every month, right? So more mutual funds close out their fiscal year at the end of this month. Why is that important? Well, when they close out their year, they need to rebalance. They need to do their distributions, capital gains, dividends, and interest. That could lead to some selling, and is not uncommon. If you take a look at kind of the seasonal month of October, the last week is kind of a rough month for the markets historically. Now, again, that doesn't mean major down days, anything like that. But, having a bit of a correction wouldn't be surprising. We saw a little bit of that selling again, kind of a last week. And, Friday before last, we kind of saw that down day. We could see another one of those or two as we get ready to wrap up the month. Then that will, that will set you up. And as we talked about in this last weekend's newsletter, that will set you up for kind of the year-end rally. Buybacks come back. Earnings should be good for companies. We've lowered the bar enough to have millennial earnings season kick off, and everybody beats estimates. Everybody gets a trophy. And then, of course, just a lot of retail momentum. I posted a chart out this morning. We've talked about before that, Wall Street is really, really good at providing leverage and providing product. They provide product. And when there's a lot of demand for a specific type of product, remember back in 2021, it was all about SPACs. And we couldn't get IPOs out fast enough, so we all created SPACs to sell to people. And retail investors piled into those, and it didn't work out well at the end of the day. But that's what you get when there's a rush to sell anything on Wall Street. They're just trying to get product out to the market. They don't care whether or not it performs or not, but they just want to collect the fees, right? Well, now there's a whole rash, and we've talked about before, is that the number of levered ETFs have been just rising sharply over the last 3 years. Retail investors are taking on more and more leverage across the board. Margin debt is ramping up at the fastest pace on record in the last 5 months. We're seeing just investors kind of piling into leverage, and so ETF providers go, well, here's a 2X ETF, and everybody's like, yeah, I like that 2X ETF. Can I have more? So they go, okay, well, here's a 3X ETF. Can I have more, sir? Thank you. Please, I need more leverage. I'm not making enough money in this market. Well, Wall Street's very happy to oblige you. Have now come out with 5X ETFs, 5 times leverage on different positions. And I posted a chart of this on X this morning. So if you go to my X channel, at Lance Roberts, you can actually see the list of 5X leveraged ETFs. 5X leveraged ETFs are fine. There's nothing wrong with them when they're going up. But you have to remember that leverage is a double-edged sword, and the edge that cuts you cuts the most deeply. So when these things reverse at 5x leverage, you're not going to lose some of your money. You're going to lose all of your money because options are going to go to zero pretty quickly. So again, but this is the market environment we're in. Very, very retail-oriented, speculative activity. And again, I get it. Right now, there just doesn't seem to be a risk. Every day, things just go up. You know, you got stocks going up. You know, yesterday was a good day of this. Stocks were up over 1%. Gold was up, 4% yesterday. Bitcoin was up 4 or 5% yesterday. Small caps, mid caps, international, everything was up yesterday. Everything was doing fine. So again, just every time we have these dips in the markets, we get this retail buying coming in, and now they're doing it just on a lot of leverage. Again, this can last, momentum trades in markets can last a while, but understand that they do eventually end. So here, let's go through some markets this morning. Here's what you need to know before the bell. So yesterday the market did climb above the 20-day moving average. That's good. That's bullish. We came down. We retested the 50-day moving average 3 times, give or take, and then broke back above resistance yesterday. This morning, markets are kind of opening flat, so we'll see kind of how the market opens up this morning. But again, this is a good bullish sign. If we can break out to a new high today, if we can kind of get out of the gate this morning and get the markets going up, and we don't have much room to go here to get to a new high, that would confirm that this pullback to the 50-day moving average was a good successful test. You've now broken out to a new high. Market bullish trend remains very much intact. There's really nothing wrong with the markets. We're very close to turning that MACD momentum signal back onto a buy. That would also be supportive of higher prices. We worked off some of that relative strength. It's starting to rise again. That's helping support this recent rally. So again, things are working just fine, kind of at the moment. And again, this is that, buy the dip mentality, which is having the biggest return in 33 years this year, buying the dips. So if you're just buying every dip, you're making the most money you've made in 33 years doing that strategy. On the Qs, of course, very much the same, but it's actually breaking out to a new all-time high. So again, you've got the Qs, the index. And again, if you look at yesterday's kind of market, Apple was leading the way yesterday. Technology was the main leader and main provider of the lift yesterday, but it was a good solid day across the board. But NASDAQ doing well. RSP, which is the S&P 500 equal weight, very different picture, has been coming down, actually tested the 100-day moving average. So again, just a very different picture of the market. Again, it just kind of shows you the lack of breadth within the markets, that the equal weight index is underperforming as much as it is this year. That gap between the kind of the mega caps and everybody else is continuing to grow right now. But again, just shows you that lack of breadth, which is problematic for the market longer term. Small caps, they're doing very well. Also, kind of rallying off, had come down, tested the 100-day moving average. Again, small caps kind of lagging large caps right now, but they are also improving here, about to trigger a buy signal also. So again, may get some of this kind of speculative push back into small caps here, just as if they can get their feet back under them. Mid caps also coming back above moving averages also. So again, you're seeing the same thing, retest of support, rally back. So again, this kind of the buy the dip across the board. Flipping over to the dollar real quick. Dollar's been holding support here. We had a nice rally, I talked about when we had this rally, so we got a bit overbought here. Look for a pullback to support. We pulled back on support in the dollar, bounced off that support yesterday, building a nice rising trend right now. I've had this very long base, multiple bottoms, and now you're building this kind of rising trend line in the dollar. It's not overbought right now, sitting on, and still on a momentum buy signal. So again, we could see some more move here in the dollar. That move in the dollar has also been feeding into bonds, which interest rates are coming down, and yesterday back below 4% on the 10-year Treasury. So again, bonds have been doing very well here also, as interest rates have been declining really for the last 4 or 5 months. Interest rates have been coming down pretty decently here. That's been lifting up bond prices well. Bonds actually yielding, returning about 4 or 5% for the year so far. So again, bonds doing well. That's due to that rise in the dollar. More foreign investors coming back into U.S. dollar. Anyway, that's what you need to know before the bell this morning, and we'll pick up right after the break with John Penn, talk about 2 dads on money, and everything you need to know about whole life insurance. I know it's exciting, but there's actually some good money tips in this. Don't go away.
the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And good morning and welcome to the show. Of course, it's Two Dads on Money. Sitting here hanging out with John Penn this morning, and got a few things to get into as always. Real quick before we get into talking about life insurance, which is so exciting, so exciting. My wife hates talking about life insurance because she doesn't like talking about anything about mortality.
Well, it can be emotional.
Yeah,
very much so.
So she's like, I don't want to talk about it.
Yep.
Just do what you got to do. But before we get into that, real quick, there is a good bit of headline stuff right now coming around. There's been some kind of credit-related product, issues as of late. We had Tricolor up in Dallas with the auto loans, and of course, this is starting to bring in a little bit more concern about the markets. And again, kind of this kind of immediate throwback to the subprime crisis in 2007. These are very different in terms of the structure and the size and things like that. I'm not saying that they're not a problem, but we need to be paying attention to what's going on with a lot of this kind of subprime credit that's going around out there, because a lot of that is tied up into private credit. And again, private credit has been one of these products that Wall Street has found that there's a lot of appetite for. And so there's been a lot of money put into private credit funds. And you've heard, if you're not familiar with private credit, it's kind of the inverse of private equity. You hear a lot about private equity companies, PE funds, where they go invest in companies. Well, this private credit is simply the same thing. It's just a private fund where people invest money and they go out and they take on credit from other companies. Now, some of these private credit funds are great. They're really well run. They understand the credit risks they're getting into, and then some of them are not so great. And a lot of this like Tricolor type debt has wound up in a lot of that private credit side. So again, if you're in private credit, you really want to, just don't look at the slick glossy that's given to you by the fund manager. Really dig in there and make sure that you don't have a bunch of this type of subprime credit, because if this credit issue is the beginning of a larger issue, right? And again, it's not surprising. I was talking the other day, Mark Cuban's investing in a company that gives loans to individuals on their automobiles that are subprime credit. So if you have low credit score, which means you can't really go to the bank and get a loan, but you need money, and you have some equity in your vehicle that you still owe money on, right? You can take out credit and on that, and they'll give you this, and this is what this company does. That's a surefire, guaranteed way at some point that company's going to wind up with a bunch of automobiles they can't sell. So, but that's what's going on in the markets right now, and you just need to understand what that risk is, and it's not become a contagion yet by any stretch of the imagination. But there are warning signs in that lower tier credit bracket that there is now consumer stress. There was an interesting graphic out this morning by Statista showing that 33% of Americans now have more credit card debt than they actually have in savings. 13% have no credit and no savings. In other words, they're just living paycheck to paycheck, right? So, and while they usually go, well, Lance, that's still 53% of Americans that have more savings and credit. Yes, but that number is down 10 percentage points over the last decade. So the number of people in the positive category is deteriorating. And that's really kind of an endemic sign of what's going on within the economy.
Yeah, so a little bit more about the private credit space. Those are like private credit, it's non-traditional loans, like non-traditional lending strategies. Maybe my credit's not healthy enough to go down to the local bank to get a loan for buying a home or buying a car, whatever that might be. Well, I'll go to the Bank of Lance and maybe he'll loan me some money, but on probably much higher interest rate terms, right? So if you're exploring private credit or alternative investment strategies, not that private credit or alternative investment strategies are bad. You just need to know what are the underlying investments in that strategy before you invest in it. So like Lance said, just don't look at the gloss or the slick. Just don't look at the marketing material. It's going to look great. But the person that may be suggesting this alternative investment strategy or this private credit strategy to you, have them go through and spend some time with you and really describe what those underlying investments are and what they're designed to do. And if we are, who knows, if we get into some more economic stress or if we get into a more volatile economic environment, ask, hey, how would these investments potentially behave? So those are all things that you should really know before you put any of your money in there, because then all of a sudden you might have money in an investment that's kind of quote unquote dead money.
Yeah, no, that's right. But this is all the stuff that kind of gets investors trapped, which is, they start investing and then they're told by somebody, somebody comes along and is like, oh, I've got this really great deal for you. And they show you this nice, slick, glossy and all these great returns. And this is one of the traps that people got into with opportunity zone funds when right after the first Trump administration created opportunity zones. Everybody went out and bought kind of these real estate properties, turned them into opportunity zones. But there were just so many of them coming to market. There were good deals in there, but there was also a lot of bad deals that were put inside of that as well. And so, you look at these returns and it's like, oh yeah, over the next 10 years, we're going to make all this money. We're going to refinance at year 5. You're going to get all this cash back. Well, then, things happen. The properties weren't as good as purported to be. And then interest rates went up, which completely messed up the refinancing. So this is what I'm saying. You've got to be really careful when investing in, and again, nothing wrong with private credit, nothing wrong with private equity. Just make sure that what you're investing in, you really understand it, because it's really easy to get into these traps where, they told me, I looked at the slick and it said these returns are going to be fantastic. And then all of a sudden, the unexpected happens, right? Interest rates go up or the market crashes or whatever it is, or there's a lack of demand for those products now and you can't get rid of them. And the problem with a lot of these private issues is that once you're into them, you can't get out of them. Right. They get locked up. There's no exit strategy. There's people that, I remember back in late 1998, 1999, there was an advisor that was on the radio all over the country, and he was promoting this REIT. He says, oh, you need to have part of your money in this private REIT. And a lot of people are still, that REIT was supposed to go public, and it never got to public because of the financial crisis and everything else that happened. There were people still locked up in that for like 15 years trying to get out of it. So just be real careful about what you're getting into. Okay, enough of that. I just wanted to touch on private credit this morning because that's kind of making a lot of the rounds right now. A lot of headlines around that right now. Because you've had Tricolor, and then you've had a couple of other ones that are already starting to show some signs of stress. So if you're in the private credit space, again, just kind of make sure what you own. So talk about a little bit about whole life insurance policy. So lately, there's been quite a few videos I've caught on TikTok and other social media platforms talking about whole life insurance. And they're spinning it in a manner it's called, just be your own bank, which is that you can overfund a whole life insurance policy, and that over time, that'll build cash value, and then you can basically loan yourself money from your own insurance contract at a lower interest rate, and then you pay yourself back over time. And there's a lot of truth to that, right? There's a lot of truth to that. However, there's also a lot of ways to really get yourself in a bind by doing or trying to endeavor in that by not understanding all the requirements that come along with being your own bank. And just full disclosure, I have a whole life insurance policy that I've overfunded for years, and I do now use that as a bank, so to speak. I do borrow from my insurance product. I do hard money lending with it, and then where I can capture a spread between what the insurance charges me on interest rates and what I charge for the loan, and then I capture that spread in between. So that is very useful for that type of thing, right? But it's also very easy to misuse it and wind up getting yourself into trouble.
Yeah, and so we're not talking about term insurance, where with a term insurance policy, it's, as it says, it's for a specific term, where term is pure insurance coverage for a specific period of time, 10, 20, maybe 30 years. Premiums on that are usually much lower, much more affordable. What we're talking about here is more whole life insurance policies, or variations of life insurance policies that you can build up cash value. Sometimes this is also known as permanent life insurance coverage, because unlike term, these cash value life insurance policies are designed to provide coverage for you for your entire life, right? And so when premiums go into a life insurance policy that's building cash value, part of that premium goes towards the death benefit, right? And then the other part of that premium that you pay in goes into the cash value side, where that cash starts to earn interest. Or depending on how the type of life insurance policy, cash value life insurance policy you have, it could be whole life insurance, where that cash value really just earns a stated rate of interest over time. It's somewhat predictable. There's universal life insurance, where there's also a stated interest rate on how that cash value will grow. A difference between whole life insurance and universal life insurance is that universal life insurance, there's a little bit more flexibility with premiums and how you can pay into that cash value life insurance policy. There's also indexed universal life, and as the name says, index. That's where the performance of the cash value, I call it a bucket or component of that life insurance policy, is tied to an underlying market index, like a Standard & Poor's 500 index, for example. And there's typically, much like how Lance and I last week, we were talking about, indexed annuities, where you can have the value of your annuity tied to an index, and you would receive some of the upside of the market, but you're capped to the upside, but there's a floor to the downside. Or let's say if markets go down in value, that particular index that you're tied to, even if the index goes negative, you don't lose money that year from a principal standpoint. Same thing that's the same concept in indexed universal life, where the cash value is tied to that market index. Then there's variable universal life, or they call it VUL policies. That's where you actually can have some variance to the upside or the downside, because the cash value of those policies is the performance of that cash value is really tied to an underlying portfolio of mutual funds that you choose, right? So that's where you've got the opportunity potentially for higher return on your cash value, but you actually are subject to downside volatility on that as well. So,
but let's keep. I know there's a lot of different types.
Yeah.
So let's keep this very basic this
Okay.
morning, because I want to touch on a couple of things. Because again, we're running a poll in our chat as well this morning.
Okay.
Which again, there's already about a third of the people are saying, well, I'll only use term. There's problems with that. Dave Ramsey was Dave Ramsey hates whole life insurance. He's like, and another question is like, no, I won't use whole life insurance because it's too expensive. Be careful with that. Dave Ramsey for years have told people, just buy term insurance, and then, what are you supposed to do? You buy term insurance and do what?
you can convert it.
No, you buy term insurance and you invest the difference.
Well, you can do that too.
Right. So what he fails to tell people, is that he says, just buy term insurance instead of paying whole life. So let's just use some round numbers, right? Just because it's early in the morning, I haven't had coffee yet, and so let's just keep it easy. Let's say that your annual premium on a whole life insurance, policy is, $5,000 a year, and your term insurance is going to be $2,000 a year. So he says, just buy term, and because you don't need this. Well, a couple of problems are going to mature out of this. So let's say you're in early on in life. Let's say you're in your early 20s, maybe even early 30s. A term insurance policy is fantastic, right? Because you don't have a lot of excess spending capital, most likely. If you do, fantastic. But most likely, you just need enough, insurance to cover you and your wife and your kids in case something happens to you. So again, this is where people come up with these kind of rule of thumbs, 10 times your income and term life insurance. Well, what Dave Ramsey doesn't tell you is that the difference, you're supposed to also go out and price out a whole life insurance policy at the same time. And so again, we get these two premiums that come in for the year. So just to have the insurance, there's a $3,000 gap between two. So you go, well, I'm going to take the 30-year level term and I'm going to have term insurance for 30 years. Great, no problem. So you're going to pay $2,000 a year for 30 years. You're fantastic. Something happens to you between the age of 30 and 60, you're covered, right? Now you're supposed to be taking the $3,000 difference between those two and investing that to an S&P 500 index fund. But people don't do that, right? We buy the term and we spend the difference. And so we don't get the savings built up. Well, here's what happens at the age of 60. Your term life policy now expires. So now you have no insurance, you have no money in the bank, and you now have to go out and try to get insurance again. And potentially you've got health issues now at the age of 60. I wake up in the morning with things that hurt. I don't understand why. But it just, those things happen, and all of a sudden it's harder to get approved for insurance. Your insurance is a lot more expensive at that point. Even term insurance, if you can get it, is much more expensive at 60 than it is at 30. So again, you've got to be careful with a lot of these, just, kind of coming off the surface, oh, it's just too expensive. Be careful with that, right? You get what you pay for. And the advantage of whole life insurance, if I'm just buying whole life insurance, is that it's permanent insurance. I'm going to have it my entire life. So it doesn't matter what age I pass away, my family's going to be cared for. And that's the reason we have insurance. We don't have insurance technically to make money with, although you can do that. We have insurance to hedge off the risk of an unforeseen catastrophic event that leaves my spouse and my kids without income. And this is the thing you're really trying to pay attention to. So my point is just be real careful just saying, oh, it's too expensive, or I'll only do term because that's what Dave Ramsey told me, whatever it is. You've got to be thinking ahead down the road about what it is that you're actually paying for, because again, you pay 30 years of term insurance and get nothing, right? At the end of 30 years, when it matures, it's over, it's done. You spent 30 years paying $2,000 a month or $2,000 a year, whatever, and it's over. Right, so that's to me, that's kind of expensive.
Well, so by the time when you get 60 years young, I mean, let's say your term insurance policy then expires when you're 60 years young. I mean, you can go out and try to get renew or get another term insurance policy, but at that point you can. But at that point you are a much bigger risk to the insurance company because you're older, right? Which means there's a higher likelihood that insurance company is going to have to pay out. Right, so they're going to charge you more for that in the form of the higher premium. So going back to these cash value life insurance policies, how these can be utilized. One, yes, it provides the death benefit, right? But then at the same time, you can grow and build cash value over time. And as you get older, and as this cash value grows and it builds, as long as you follow some rules, and we'll get into what they call a MEC, or a modified endowment contract, is here in just a moment.
So exciting.
Right, so exciting, right? I think it is, right? But as you grow this cash value, you can use it. It's almost like a tool in your tool shed of kind of various buckets of money that you can pull funds from, right? Because as you're saving money, you're putting money into pre-tax accounts. Maybe you have after-tax accounts, brokerage accounts, what have you. You want to look at not just having a diversified investment portfolio, but a diversified account strategy of different buckets of money that you can pull from. And as you get older, what sort of withdrawal sequence makes sense where you can manage your distribution strategy to manage your taxable income when you get older? Well, if you've built up cash value in a life insurance policy, you can borrow against it. You can take a loan against it. And that is a tax-free loan against those dollars that's in that cash value life insurance policy. So, if you're trying to keep your taxable income within a certain tax bracket, and you're kind of buttoned up to that bracket, and you need more income, and you want to avoid going into the next bracket to pay some taxes, you can borrow against the cash value life insurance, the cash value amount in your life insurance, and that's tax-free dollars, right?
And there's really a big advantage to that too, because let's say, and here, so first of all, there's a couple of things you need to understand about this. Is that one, if you're thinking about doing the whole life insurance policy to be your own bank, again, this is something I do myself. You have to understand how to go about it, and so be careful when you're talking with your insurance agent or whoever is selling you the insurance policy, because you need to go into this and you want to buy the least amount of whole life of life insurance coverage, depending on your budget, whatever your budget is. You want to buy the least amount of that insurance coverage as possible, so you can overfund on your whatever your budget is. So let's say you've got $10,000 a year that you can put into this product, right? And so you want to buy the least amount of life insurance coverage possible so you can have the maximum amount of overfunding, because that overfunding falls into additional paid up insurance that is creating that cash value that you can now borrow against. Now here's the downfall of this. This takes a lot of time.
Yeah.
This isn't something that you're going to go out tomorrow and set up and then immediately have $100,000 of value that you can borrow against and go, do whatever you want to do with it. This takes years to build up this bank. So one of the traps that you've got to be aware of is that when you commit to this process, you're committing to this technically for the rest of your life, because you've got to keep paying the premiums, you keep doing the overfunding to build this bank. And so as you continue to build the bank that you're going to borrow against, this is going to take years and years and years and years to do it. And so, as you build these, you kind of look at this as this is going to be, for the rest of my life, I'm going to be paying into this insurance product until the day I die. All right, just look at it that way, because now you've got to come back on your budget and make sure that you can meet that funding requirement every single year.
Yeah, it's not uncommon when you are laying out these premiums to start building up these cash value policies. It may take 8 to 10 years of premiums going into the policy before you actually start to see your cash value start to overtake what you've paid into your premium. Mm-hmm. Because in the early stages of the policy, I mean, you're working with an insurance company, and I haven't really found an insurance company yet that works for free. Mm-hmm. And so when you're putting premiums in every year, there's costs to have this insurance policy in place. And so as you're putting in these premiums, before all of that premium goes over into the cash value side, the insurance company is taking their piece of their fee. Right? So you really have to watch. You really have to, like Lance said, you really have to commit to this, because it usually takes somewhere between 8 to 10 years, in my experience, from what I've seen, for those premium payments to kind of have that crossover point where those premiums, where your cash value starts to grow, be worth more than what the premiums you've used to pay in. It takes about 8 to 10 years on average, right?
Well, and again, it's like, Peter in our chat says, most consumers just need term. High commission permanent policies are definitely necessary for old high net worth people who live off debt against their assets. That's not really true at all. And again, when I was younger, I was using term. And until I started to really understand what I was paying for and the expense that I was paying out versus what I could be doing with my money over time. And that's when I flipped over to whole life insurance and been building that value over time. This is not something, look, whole life insurance has a lot of uses for old high net worth people, for estate planning, setting up, an ILET, which is a life insurance payout. So when you pass away, it pays off all your estate taxes. Absolutely, for estate planning purposes, whole life insurance policies are definitely needed. But for younger people, my kids will be doing this as soon as they graduate college, they will buy a whole life insurance policy and they will start overfunding that, because if I could go back in time and do my life over again, I would have bought whole life insurance and overfunded it from day one. Because again, the money not only grows tax free, it's also withdrawals tax free at the end of the day. So when I want to borrow against it, I can borrow against my assets on a tax free basis, and I can pay myself back. And then when the insurance pays out at death, it's a tax free payment. So again, there's a lot of benefits to building this as part of your investing plan. So it's great to go out and invest in the stock market. That's fantastic. But you can create a lot of wealth by investing in a whole life insurance policy and doing it correctly. And if you do it correctly, it can work very well for you. You do it incorrectly, it can hurt you, just like everything else, right? I can invest in the stock market and lose a lot of money. And again, like one of the things that, so let's say that, here's a good example of this. Let's say that I'm overfunding my whole life insurance policy, and I'm getting paid a dividend every year based on the value of my policy. Let's say I build up $100,000 worth of cash value, and the dividend that's being paid out every year is 4%. So I'm getting a 4% payment on my $100,000 every year. So every year I'm adding 4% to my portfolio every year just from the dividend coming in from the whole life policy. So let's say that I have another investment that comes up, or let's say I want to borrow some money against my policy for, I'm going to buy a piece of rental property and they can yield me 6% a year. So if I'm going to borrow against my policy, let's say that the borrow rate is 4%. Just let's keep the numbers even. I can borrow from my policy at 4%. I can go invest in my real estate property that's going to make me 6, 7, 8%. But when I pull that $50,000 out to go buy the real estate property, which I've done with some leverage over here, that's going to increase my overall net return. The $100,000 that's here, it doesn't recognize that $50,000 has been borrowed against it. It's still growing at the full face value at 4% a year. So again, I'm building some leverage on that side in terms of my return, and I can borrow against this tax-free to go make other investments that generate me a higher rate of return. Then I can then pay that loan back at some point in the future, and is still building that value. So this is the banking part of it that you hear a lot on social media, is that you can use this very, very effectively to build wealth over time and create a tax-free payment at death.
Yeah, and Peter, you're right. These cash value life insurance, it isn't for everybody. This is not a one size fits all. It's very bespoke or unique to the individual that based upon their lifetime, right? Because I see cash value life insurance also used quite frequently when maybe somebody, they've already maxed out what they can to their IRAs. They've maxed out what they can save to their 401k plan, whether if it's pre-tax or Roth or maybe a little bit of each. They're on a high deductible health plan and they're contributing and maxing out what they can to a health savings account. And maybe they're fortunate enough to still have additional assets left over that they don't need for their basic living expenses. These are additional dollars that they can invest for the long term. In that type of situation, when somebody has extra money that they can set aside and invest, a structure like a life insurance policy that can build up cash value can be an attractive option when they've maxed out all their other savings vehicles. There are also folks that maybe they're a highly compensated employee at a business and they're phased out of being able to participate in their employer-sponsored retirement plan. So a cash value life insurance policy can almost be a replacement for them for what that retirement plan would have been, right? So there are some very useful, there are some very specific situations where cash value life insurance policies can be a very useful tool depending on the situation of the individual or family. But you're right, it's not for everybody. The premiums that you put into this are not inexpensive. So you have to make sure that if you are committing to a building up cash value in a life insurance policy, that you need to be able to afford those premiums and commit to it, right? It's you have to make sure your budget can facilitate that.
Right, and again, again, making a blanket statement where only rich people need whole life insurance, that's the problem with a lot of the things that we have going on within society right now, which is just this kind of blanket attitude about certain things. The reason that 33% of Americans have more credit card debt than they have savings is because they've just been told that, you should just go buy everything you want to buy and then just put it on credit, it's fine. But that's the banks promoting that. So, hey, let's, more credit to you, fantastic. I'll give you all the credit you want. You just, go buy everything you need, but then you wind up financially struggling. And so, again, be real careful with these blanket statements because, again, your situation, and again, when I'm talking to somebody as an example, maybe they only do need term. Maybe they are in a situation where term policy is exactly what they need because they just don't generate enough excess savings to be able to commit to. We're not even saving money, right? We're just in the position where it's like, you just need to get some term insurance in case something happens to you because you're living paycheck to paycheck. Absolutely, term insurance is good for that. But once you start building a little bit of wealth and start building a little bit of excess income and starting getting yourself on a good financial track, you need to start considering your longer term picture of what you're spending money on and what you can do to make that money work for you every day.
Yeah, and so a little bit earlier I referenced a MEC or a modified endowment contract. This is something you need to be careful of when you're looking at putting money into a life insurance policy where you can build up some cash value. And what MEC status means is, when you are putting money into a life insurance structure where you can build up cash value, I'm going to kind of get in the weeds here a little bit, but if you fail what the IRS calls the 7-pay test, that life insurance policy could turn into what is called a modified endowment contract. And that is where you're overfunding the policy too much, putting in more cash than what is allowed under IRS limits, right? Then that becomes a modified endowment contract. So basically that 7-pay test measures whether the total premiums that you've paid into the policy for the first 7 years exceed the amount that's needed to fully fund the policy, right? So you're putting in too much cash value up front. Then that life insurance policy becomes what is called a modified endowment contract. Now the death benefit, that will still pass to your loved ones tax-free. But the way that Lance was describing on how you might be able to use the cash value in a life insurance policy to borrow against it, that tax-free, advantage, that goes away. Right? So those are little things that you really have to be careful of, because if you're really trying to use this cash value policy as a way that you can, tap into tax-free income at some point in the future, if it becomes a MEC, you lose that advantage.
That's correct. And again, this is just part of, part of this. And so one of the questions that just came in chat was if I have a heart attack or I get cancer, then my life insurance premium, it doesn't change because I'm already set up on this. And so no, they don't come back and say, oh, now you've had a heart attack, so now we're going to raise your premium. That won't happen unless I have term insurance. My term insurance expires and I've had a heart attack or now I have cancer and I try to go get additional life insurance. This is, and a good case study of this. I was working with a prospect about a decade ago, and he was a high net worth individual, and I was talking to him about getting life insurance. And I was like, look, you need a life insurance product. We need to get this put into place for your estate planning, et cetera. And he kept him-hawing around. And, he's like, oh, yeah, I'll go get the test done, and I'll do this, and I'll do this other thing. And, and every time we'd get the appointment set up, he'd find some reason to cancel it. And it was going back and forth on the pricing. It was just, it's so expensive. And so finally he goes, okay, fine, I'm going to go get the policy, right? So we had him go to the doctor. This process took like 2 years. So like 2 years earlier, he went to the doctor and went through all the tests. He was completely healthy. Everything was fine. But then he started him-hawing about the price, and he just didn't know, and it was back and forth. And so 2 years later, goes back to the doctor for the test. He's finally we're going to put this into place. We're going to get it done. Finds out he has prostate cancer.
Oh, wow.
So now he can't get covered. So again, this is the problem. You want to do this when you're healthy, because as you get older, and again, as I was saying earlier, it's great to have term when you're young, but when you turn 50, 60, that's when stuff starts happening. And all of a sudden you may find out you can't get coverage.
Yeah, and maybe you have a term policy in place now. Maybe it's been in place for a number of years, and now you're getting a little bit older, right? Sometimes with your Explore, maybe it makes sense. Talk with your financial representative, talk with your fiduciary to see if something like this might make sense for you in your situation. But there are times with those term insurance policies that before it expires and you have to go out there and buy another term policy, you might be able to convert that term into permanent insurance. You might be able to take that term policy and convert it over to whole life, right? And maybe the premiums at that point might be a little bit more affordable, because maybe with that term policy, maybe you needed at the time when you were younger a much larger death benefit. So that way, if you passed away at a younger age, you just wanted to make sure that your loved ones were provided for. Well, now that as you get older and you've accumulated more assets, you might be able to convert that term over into whole life that has a smaller death benefit, and then you can start building up cash value from there. Maybe those premiums to start building up that cash value might be a little bit more affordable. But here's another possible advantage of maybe talking with your existing carrier that you have a term insurance policy with, and you're considering converting it to a whole life policy. They already know you. You may not need to go through medical underwriting. You may not. So that's something worthwhile to explore. So I just wanted to mention that as well.
That's right. So anyway, I hope this answers a lot of your questions. If you have more questions about it or want to explore it some more, be sure and go by the website and send us an email. I'll get it to John. John will be happy to we'll kind of walk you through all your options. Again, these are not a one-size-fit-all product. and they are not something that everybody should have, and everything depends on your personal situation. So whether it's term, whole life insurance, universal life insurance, annuities, whatever it is, we've spent, last week we covered annuities, this week we're covering insurance a bit, but these are, very necessary products if they're used properly. And again, that's the key to all of this, is that not everybody should have these products. They're not the right fit for everybody. And as we warned you last week about annuities, when somebody only has annuities to sell, they've got a hammer, everything's a nail. Right. So they're going to sell you an annuity, and these should not be all of your investments, right? You shouldn't have just, I'm putting everything in my whole life insurance. That it's not a one size fits everything investment either. So, these are things that have to be planned accordingly. And again, this is what John and Rich and Danny and Jonathan McCarty do very well at our firm, which is they plan for what your needs are to make sure that your financial planning gets you to your goals over time. And again, everything is unique and it needs to be tailored. So if you have questions, get by the website, realinvestmentadvice.com. Just click the Ask a Question button, send us an email. We'll be more than happy to kind of answer your questions, walk you through it, and then try to make sure that you're making the best decision for yourself. And while you're here right now, be sure and like and subscribe to the channel. It certainly helps us a lot. Our channel's been growing great lately. Thanks to you guys. We really appreciate it very much. And we'll be back next week for the next 2 Dads of Money. Tomorrow, we've got Ben Gran interview that we're running. It's a really, really good interview, especially if you have kids. I encourage you to watch it if you have kids and trying to get them saved. He's got some great, we have a great conversation, almost like 2 Dads on Money with Ben Gran tomorrow. But really good conversation with Ben in regards to helping raise kids, being financially smart, etc. That's going to be on tomorrow's show, so we'll look forward to there. Like, subscribe to the channel. See you then.